Is it finally time to repurchase a Tesla stock? In this video, we are going to analyze the fundies, the fundamentals of Tesla stock. First, it's important to know that a lot of folks about a month ago, seeing bad deliveries coming, decided, you know what, let's trim NVIDIA stock and trim Tesla stock and use them to offset each other as a tax loss harvest for the tax lots that you had purchased at higher levels. That doesn't mean all of your shares are potentially negative. Most people know, and in case you don't know, there are brokerages that let you pick which shares you want to sell. So let's say you have some Tesla stock you bought at 50, some at 100, some at 150, some at 200, 250. Well, you could sell those at 250 and 200 by picking those out, telling your broker to sell specifically those tax lots, take a loss on those without affecting the sales on your original stocks that have gains, those shares. So then you could offset that with something like an NVIDIA, which peaked out about a month ago around that 950, 970 level, and now it's sitting in the high 8s, 880, 850 is where it was yesterday. So there's been an opportunity to pull that kind of trade. The question now, though, is are the fundamentals strong now to where reallocating to Tesla makes sense? And in this video, we're going to analyze exactly that. It's worth noting that there have been a few pieces out from the street on Tesla over the last few days. It's worth taking a peek at a couple of these. For example, Adam Jonas, who's a really big Tesla bull when it comes to the software side, he says Tesla has a big moat when it comes to data and compute. Do note that Tesla's in-house computing segment, which Adam Jonas gives a lot of valuation to, Dojo, was sort of called a high-risk, less likely to happen bet by Elon in last earnings calls. And that negative sort of pessimism on Dojo was a little disappointing for some Tesla investors. But it's true, Tesla still has the data, the lead on energy. The question's going to be, what's the path to monetizing robotaxi? We'll talk a lot about that. You go to Barclays, and they have a piece where they basically compare the Uber bulls and the normal bulls. They call them the rational bulls, those that are just using reason and logic, and then the exuberant bulls that are a lot more enthusiastic. I meant to switch to this one. We're going to go to that spreadsheet in a moment. We're going to go through 4 scenarios here. But here is that Barclays piece. And they suggest that rational bulls think the pivot away from the Model 2 is actually dangerous because it reduces vehicle volumes for the company. Barclays goes as far as saying 60% of their 2023 volume for Tesla comes from the Model 2. So you kind of really want to see some Model 2 movement for Tesla here. Whereas what they call they think that rational bulls see the Model 2 as maybe the iPhone moment for Tesla, where you could really get this broad-based expansion, compete with the Hyundai, the Civics, whatever, right? The sort of the Corollas of the world. You want to compete in that low 20s tier, the 19 to 25K. So there's been a lot of enthusiasm around that 25K car, bringing that mass market opportunity. Again, the Uber bulls see this as, oh, robotaxi is closer. This is really good news. This is really bullish. It means we're about to be at robotaxi version 12.3.4 just came out. I have not tested 12.3.4 yet. I'm on 12.3.3. I got the download. I gotta update it, but I haven't done that yet. But for the purposes of this fundamental video, we're going to go a little further than just, oh, what's the latest update? How's the latest update? Because we've got a lot of work to do when it comes to FSD. That's not saying it's not great. We posted a pretty good survey on ehack.com. You can see that here. This is from Twitter, and so we cited them here. You could click on the link for that. But this is a very interesting personal FSD progress tracker survey, and so they collected data to see how people think 12.3 and versions 12 are behaving. And really what you find is it's gotten very good at smoother left and right turns. However, it is more likely to clip curbs now, which is not great, so you gotta be careful on that. It's substantially better at lane changes and heavy traffic, slowing down for bumps or dips, much better on this. But it's still having issues on hand signal navigation when there are traffic cops, understanding new road signs, pulling over for emergency vehicles, behavior at flashing red lights, bad at, it basically doesn't reverse, not great at parking, very bad at avoiding potholes or avoiding, coasting in people's blind spots. Those are some issues that it has now, but gotten much better at things like roundabouts, for example, where previously it was terrible and now it's actually pretty functional at roundabouts. So FSD is definitely improving. Is it full self-driving yet? No, but it's definitely improving. You've got brand retention that's the strongest over at Tesla compared to any other brands. So you've got a lot of enthusiasm for the stock. And the brand itself. The question is, can we actually get to a place where we're going to see this enthusiasm translate into fundamentals? Right now, you can see Tesla stocks down about 75 bips on the day, hanging out at that about 170.02 line. Let's see if we're able to hold on to that support for those of you trading. Remember, I send all my alerts to Stocks and Psychology of Money course members, where we do technical analysis and fundamental analysis on a daily basis, and you get lifetime access to that with no recurring fees. So what do we want to do over here? Well, on this spreadsheet, this is going to be a little tricky, okay? So you're going to have to kind of roll with me on this one. We're going to go down one column at a time, and then we're going to just change very few things so you can see some changes here. The first thing we're going to do is we're going to assume 2.5 million vehicles delivered for 2026. So these are going to be 2026 numbers. And the way we're going to come up with that is we're going to assume flat for 2024. And then we're going to go with about 18% growth for 25 and 6. That should get us all the way to 2.5 million vehicles delivered for 2025. Now, that's a far cry from where we used to be at like 3.1 million vehicles or even 3.6 million vehicles where some estimates were for 2025. So the estimates have come down substantially. It is worth keeping in mind that one of the biggest ways Tesla can increase their earnings per share right now is through vehicle deliveries. This is why there's so much talk about that compact Model 2 and concerns that if we don't have the compact Model 2, we're going to get fewer deliveries. That Tesla remains a little bit more in that luxury car market space, even though you can get a pretty inexpensive Model 3 or used Model Y these days. We're going to be just focusing on new cars right now. So the first column right here is we're going to go cars only. What is the basic valuation of Tesla when we look at it from a cars only point of view? We'll go with a revenue per vehicle of about 44,000, 2.5 million vehicles. We'll assume most of that is from sales. We'll give 2% to leases. We'll say servicing is about 5%, which most of that is a break-even business anyway. And what we're going to do is we're going to be generous here. We're going to give Tesla a little bit more than a double on energy. That's going to include revenues from supercharging. It's going to be offset by lower regulatory credits, but it's going to include Megapack, solar, whatever. Over the next 2.5 years, we think an easy 2.5 double for that energy, but who knows? All of this is risky. None of it is personalized financial advice. So what do we have when we go here? Well, we get total revs, and then we're going to start getting some expenses. What we're going to do for margin is we're going to go with a margin of 82.5%. That's because the long run average you're seeing in sort of the Chinese automakers is somewhere around 12 to 15% margin. We'll give Tesla a little bit of street cred here, and we'll give them a 17.5% margin. It's a far cry from the 30% margin we hit with regulatory credits, and at one point without regulatory credits, which was really impressive. That marked the top for the stock. Since then, margin's been straight down, and we're not even over 20% right now. So we're going to go conservative. We're going to go with 17.5%, and we're going to assume that future efficiency improvements in manufacturing are just going to go to making the car more affordable rather than increasing margin so we can get more volume. So that's why I'm going to stick with 18.5% margin. In fact, one of the things we will not do is we won't be changing margin as we go through this. We're going to assume the expenses on FSD are 10%. The expenses on Robotaxi, I'm going to go with 50% expenses on Robotaxi. Expenses on leases, 55%, services, 95%, so basically break even on services. Most of the money really could come from FSD. That's where you're going to spend about 10% on chips. That could work out to $400 million this year, but in the long run, it should average out to about 10% on chips and training and all of that to make sure our end-to-end neural nets are operating as well as possible. And of course, we'll use a tax rate of 19% across the board. Then what we're going to do is we are going to use a 30% growth rate for our earnings per share. So we really want to see 30% EPS growth. If you're using less EPS growth for the average of the next 4 years, you're going to have a problem with the valuation. But we're going to leave that for a moment. So In the far left column, we're going to go 17.5% margin, 2.5 million vehicle deliveries, no FSD, no robotaxi. All I want to see is what is this stock worth from the point of view of auto sales. And from a point of view of just auto sales, at 30% EPS growth going forward for the next 4 years, I should be at about a $163 stock. That's really just 2.5 million vehicles delivered. You can see if I drop this earnings growth number to 20%, that'd be pretty bad for the stock. Let's actually put the percent sign in there. That brings you down to about $109. So depending on where that earnings growth is, if we're somewhere between 20 to 30%, you're creating a baseline for the stock of between $110 and $160 for the stock, just based on 2.5 million auto sales by 2026. Do keep in mind that if we go with 30%, yes, 163 is great, but that's $163 2.5 years out. So that's actually really bad because it gives you a net return that is negative over the next 2 years. But that's our lowest number. We're not including any FSD or robotaxi. Of course, we're also, because it's so speculative, we're not going to include insurance or semis right now. We're going to do that on purpose just to sort of make sure we're conservative as much as possible with these numbers. And I think we're already going to be very, very generous as we move to the right over here. So I don't think we need to be even more generous. We want to be realistic here. And there's been a history of being too generous for Tesla already. So now what we're going to do is we're going to go throw in FSD, all right? So let's assume that Tesla's going to have a 37.5% take rate on their entire vehicle fleet. Keep in mind, not every country is going to use FSD. Not every vehicle owner is going to pay for FSD. And even if you have a 50% take rate on new vehicles, you'll still be in like the 30s for all vehicles because some people like me have already paid for full self-driving. That does not drive new revenue for Tesla. Everybody who bought FSD for $5,000 or $7,500 like I did, you're not contributing anymore to Tesla's pocketbook. So that does hurt Tesla. So that's going to lower the take rate going forward. But what I'm going to do is I'm going to draw a take rate here. And what we're going to do is we're going to go 11 million vehicles on the road. We're going to take the current fleet and then we'll add about, let's see, flat. So we'll go about the current fleet of, say, 6 million vehicles on the road plus 1.8 flat for this year, 2.2, let's say, next. And we'll go 2.5 for the next. So we'll call it about 12.5 million vehicles on the road. So let's go 12.5, 1, 2, 3, 12 million vehicles on the road, times a 37.5% take rate times $200 times 12. That could get us FSD revenue of about $11.25 billion. That would be very juicy. That would be a very, very juicy set of revenue here for Tesla. I like that. That would be good. Let's go ahead and paste that across the board for all of these. And we will preserve the formula here so we could set this baseline in. Remember, we're only going to spend about 10% on FSD. So this is good. Like, we have very, very low expenses for FSD. So the only thing we're going to put in here is FSD. The only thing I put in FSD with $1.1 billion of expenses, I can buy plenty of H100s for that. What do I get to? My price skyrockets for Tesla to $276. Now, that would give me about a 19% return over the next 2 years, which is actually pretty bullish. It's pretty good. Now, if I do change the take rate, you're going to see a pretty precipitous change here. If I drop the total take rate to about half, so if I go about 18% right here, you're going to see that drop to about $217, but that still gives you a 9% return going forward. So you know what? Let's go ahead and leave it at 18%. We'll leave it at 18% for all of these because we want to be a little conservative, and honestly, that's already pretty good, seeing a 10% compounded return over the next couple of years. So I'm going to leave that. I kind of like that. I think we're going in the right direction here. Now what we're going to do is we're going to throw in robo-taxis. Robo-taxi... Look, the revenue over at Uber for robotaxis is about $37 billion in a year. $37 billion, about $22 billion of that just goes to labor, the people actually driving the car. So let's assume, you don't have people driving the car, and 50% could go to your pocketbook because some of it's going to lower the price of revenue that you get for robotaxis anyway. So, and then let's assume initially Tesla's only able to do about 10% of the business that Uber's able to do. Keep in mind that people aren't really going to care if there's a human in it or a robot in it initially. They're going to care about availability and price. If I have to pay $50 for a robotaxi or $20 for a human driver, I'm getting the $20 one. If I have to wait 30 minutes for a robotaxi, I'm getting the Uber that's going to show up in 2 minutes. I don't really care that much about using the robotaxi network. I want what's faster, cheaper, and more available. Yes, in the long term, as it's more available, robotaxis should get cheaper, but that could take decades to achieve. Therefore, initially, I'm going to throw my robotaxi revenue at just about 10% of what Uber is. So we're going to go with just a flat number here of $3.7 billion. I think this is way too generous for 2027, so I'm going to do it anyway, and we're going to run it at 50% of an expense ratio here. So $3.7 billion, expenses are going to be 1.850. How does that change our math? Well, hold on. Oh, I don't actually have the revenue added in here. Let me add these in. Robotaxi, wait a sec. We do have the revenue. Something is not right. Hold on. Do we have the expenses in here? Total expenses. Yep, we have the total expenses. Okay, why is my EPS not changing? Folks, we have a little bit of a problem. I have made a mistake. Oh, because it's 3.7 million. Duh, I forgot to add 3 zeros. That would be insignificant. There we go. Much better. Okay, 3.7 billion. Now you get a change. You can see robotaxi at 10% of Uber with 50% of a cost structure only gives you $20 for the share. So most of Tesla's valuation over the next 2.5 years comes from a take rate on FSD, not on robotaxi. Robotaxi is not really where you want to go, but robotaxi could actually help you sell FSD. Now, the real thing that could really help us drive volume or EPS growth here would actually be bumping volumes. And so I wrote that up here that I'm going to bump volumes to 3.1 million for the end of 2026. Keep in mind that right now we're not even expanding to Giga Mexico. Giga Mexico hasn't broken ground yet. It hasn't broken ground because we probably don't need these freaking vehicles at this point because there's not enough demand for them. So you have a little bit of an oopsie-doopsie there. Not only is Giga Mexico stalled, but you also have a stalling out on plans of moving to other countries. I know there's a lot of enthusiasm that yes, oh yes, all of a sudden we're going to go to Giga India and all these things. Meeting all of these different presidents is cool and fun and all, but it's not actually leading to any kind of realization of Tesla breaking ground anywhere because we just don't need more manufacturing capacity right now. But let's say we do get some more manufacturing capacity and we get to 3.1 million vehicles, whether that's Cybertruck expansion or at lower prices or a compact vehicle or whatever it is. Okay, we go to 3.1 million vehicles. We change nothing else. Now, Tesla stock, you can see, moves up to $258. So really, where you're trying to push Tesla stock up is all of these things. But the biggest push absolutely comes from that FSD take rate and how much money we could profit off of FSD. Now, the problem is everything to the right of the left column is speculative. We don't know what the FSD take rates are anymore because Tesla doesn't disclose them. Tesla doesn't give us forecasts or take rates on or anything on FSD, so we're totally guessing. We have absolutely no idea what's going to happen with robotaxi. If they just do a trial of 100 cars, you're dreaming if you think we're going to get $3 billion of revenue in the next 2.5 years. That would, I don't really see that, mostly because I don't think Vision FSD is fully there yet. FSD is great, and I think those free trials are going to help. So that does leave me leaning towards this level right here. I'm leaning towards that 217 for the next 2.5 years, unless we can really show that EPS growth is exploding. That's the other thing that can move the stock. If we could get back to EPS moving up by 50%, now we could change our PEG ratio and we could explode the stock back to $300 to $400. But again, that's going to require proving that we could get that EPS growth. Right now, honestly, I think 30% EPS growth is somewhat generous because we're still going through a bottoming out process. So how do the fundamentals fare? Well, the compact model makes Tesla more speculative. However, while that makes it more speculative, it also gives it substantially more upside. All we need from Elon in this next earnings call is some clarity on take rates, pricing for FSD, and forecasts. Are we going to get it? Probably not. But in my opinion, this is a rational, fundamental analysis of what's going on with Tesla stock, not personalized financial advice. Good luck, and thank you for watching. Goodbye. Oh, and is it time for me to rebuy Tesla stock? Well, you'll be the first to know if you join the Stocks and Psychology of Money group, linked down below. For now, here's my analysis.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than househack, nor am I presently acting as a market maker. Make sure if you're considering investing in househack to always read the PPM at househack.com.